Good morning or good afternoon, and welcome to our webinar, Managing Risk in 2020 and Beyond, Implementing a Forward-Looking ERM Program. My name is Jeff Rigsby, and I'm the President and CEO of CB Resource, and I will be presenting today's session. I would also like to introduce Robert Finch, who's our Senior Vice President of Sales and Marketing. Robert's also with us today. And I just want to say on the outset, Robert's always our primary point of contact here, and just want to introduce him up front. I would also like to take this opportunity to thank you for taking time out of your busy schedule. I know how these things can be. We've indicated in our invitation that this presentation and webinar will run about 45 minutes, and I'm certainly committed to keeping to that schedule. And for those of you that aren't familiar with CB Resource, we are based in Irvine, California, and we focus on three things in working with our community bank clients, and those are enterprise risk management, strategic planning, and capital planning. And our primary responsibility with our clients is to ensure that their performance and risk management priorities are in sync, and they're performing at an optimal level while taking the least amount of risk. So with that, let's go ahead and move along. Oh, by the way, before we get started, just some quick notes. If you do have any questions, by all means, you can leverage or take advantage of the GoToWebinar communication device. It should be in the lower right-hand corner of your screen, I believe. And also, this presentation will be available if you would like it. Just send us a message through GoToWebinar. You can send an email directly to me, to Robert, give us a call, and we will have a Q&A session at the conclusion of today's presentation. So let's get started. And by the way, forgive me if today's session is a little choppy. Like enterprise risk management, I think as we view the requirements of our clients, things are evolving. And I would like to mention that over the last year or so, we've sensed a material change in how our clients are viewing their enterprise risk solution, or even the decisions to adopt an ERM solution. And we're seeing a change in their expectations of what the system will do. A lot of it has to do with forward looking. So as I craft this discussion this morning, it will be somewhat fresh and new from even our perspective. But I would like to focus on three things. Right at the outset, I mentioned that ERM now more than ever probably needs to be forward looking. And so many of us are using systems that we're assessing current conditions and looking at trends in how those conditions or controls might change. But is our ERM solution really looking forward and helping us identify emerging risks and threats? So we're going to talk a little bit about that forward-looking component of ERM. The other emerging thing that I certainly want to talk about is the need and focus on outputs and decision-making. So what's the role of ERM, and what kind of outputs can ERM present to support better decision-making? And then lastly, I'd like to focus on what I would characterize as the non-negotiables of what a good ERM system should provide. And so that's the context. That's kind of the purpose. So forward-looking, outputs, decision-making, and the key processes that make the system work. I know we can easily spend the day on any one of those components, but we have about 45 minutes. And also, I would like to have you bear in mind, this is going to be about a 30,000-foot flyover. So I'd like to hit these themes, but we'll probably move with a little bit of pace. I do want to mention we have banks and individuals on this call today that range in huge differences in size of assets and in your various positions in your bank. It ties in with the fact that ERM is not a one-size-fits-all. It has a lot to do with your bank's risk profile, the complexity of your model, the size of your bank. So we want to bear that in mind coming out of the chute. And my last comment is, ERM is not about risk avoidance. It's really more about having the right size of controls to manage basically the risk your bank has adopted to optimize performance and create value. So with that said, what we will cover is the 2020 insights, the kind of things that kind of forged our thinking around this webinar. I do want to craft it into a discussion about what I would characterize as the five non-negotiables of a good ERM system, some basics about where ERM has been and where it's going, the types of solutions and the process. We'll get into the implementation of those non-negotiables and some closing thoughts and wrap up with some Q&A. So with that, it's kind of interesting. Historically, we've looked at certain drivers that lead banks to adopt ERM solutions. So if you kind of look at it on this left column, historically, I would say that banks have adopted ERM solutions, one, to just ensure you've got the appropriate controls in place to support and manage your bank's risk profile. Some decisions were made basically from a regulatory driven perspective. My regulators want me to do this and I better do it. It's not unusual that it was adopted in order to support your ability to achieve your strategic goals. And if you think about it, ERM really is all about your strategic course of action, where you're going and how you control the risks that you're taking to get there. But we'd also, the systems were adopted to improve decision making, to elevate risk awareness. Ideally, it ends up being reduces operational surprises or losses by being an early warning system. It may prepare your bank to take better action about well thought out risks, and basically to break down the silos and ensure greater business continuity. Those were the driving forces that up until today probably drove a lot of decisions to adopt ERM. But here's kind of what we're seeing percolate in 2020 and as we look forward. And there's definitely an increased or an elevated sense of urgency. And so one has to ask, so why ERM today? Why haven't I done it before? Why might I do it today? Well, some of the factors we're seeing move those decisions have a lot to do with just general uncertainty. Whether you want to look at the economic environment we're in today, if you want to look at the political environment, the global conditions, there is some volatility in the marketplace that just seems to be increasing. We're certainly on the long end of an economic cycle and a long end of a credit cycle. So there's some anticipation or sense of, hey, is the other shoe going to drop? Are things going to get tougher? There's certainly senses of higher compliance risk exposure. We have earnings pressure. Heck, if we look at just low interest rate environments alone today, if we don't do anything as a bank this year compared to what we did last year, the chances are we may make less money. In a low interest rate environment where the competition is increasing, there's downward pressure on yields, there's upward pressure on cost of funding earning assets. All those factors make it more difficult to create an optimal performance environment. Throw that in with cyber issues, new product offerings, fintechs, and just the overall fintech world and the various disciplines that involves, increased vendor management because of potential partnering solutions. Those are just some examples. Business model complexities, the elevated competition in the marketplace, both direct and indirect, just the simple need for the ERM system to better communicate to executive and management and the board to craft better decisions, or just answer the questions, where is risk going? If we want to identify emerging risk and threats, does our ERM platform support that request? So when we crafted today's session, it really was about, the landscape is changing and there is an elevated sense of urgency. And so let's talk about ERM with that in mind. So if you think of these forces and they're increasing kind of the level or the sense of your bank's view of ERM, like what is ERM doing for me in these elevated conditions, that's really what we want to take a look at today. And so I've broken it down into what I would characterize as kind of the 5 non-negotiables of ERM. And those non-negotiables are pretty straightforward, right? When I say non-negotiable, if your ERM system does anything else, these are the 5 things it should do. Now, it could do a lot of other things. It could help, report well to your audit committee. It could ensure certain controls and compliance things are in place, like a GRC system might do. But if you're looking at ERM, these are kind of the 5 things that are the money shots. These are the things that make it valuable. So when you think of number 1, if your ERM system, it really does have to frame your risk appetite in a quantitative manner. It has to really define what the level of risk you're willing to take is by risk appetite or by risk category. And how does that tie back to your strategy? And if you think about it, the first forward-looking aspect of your ERM platform is your risk appetite. It basically says what you're willing to do or not do to make money and create value, right? And so within that risk appetite, you definitely want to have it quantified by key risk category, and that's at a strategic level. You definitely want to be able to tie back key risk indicators and key performance indicators and evaluate the tolerance ranges within your risk appetite. And then the big question of risk appetite, and the reason it's so important and why it's at the tip of the spear, is it does set the calibration of the entire balance of your ERM system. If you have an elevated risk appetite in certain areas, does your enterprise risk management assessment system, is it sensitive to that? And is it aligned with that? So number one non-negotiable is a well-defined and articulated risk appetite on the front end. The second non-negotiable is your risk assessment system, right? And does your risk assessment system or platform integrate both qualitative and quantitative data? In many cases, risk ERM platforms today are relying heavily on subjective qualitative input. If there's not a quid pro quo or a balance between qualitative and quantitative data, we may be losing something, right? And does it aggregate at the right level so that you can take a look at the overall bank risk profile and then drill down through a series of queries to give us a sense of our controls, right? So that non-negotiable of a risk assessment system that fully integrates quantitative and qualitative analysis. The third non-negotiable in our view is that assessment process needs to push out a report that actually says what your top risks are. And if you know what your top risks are, you should be able to further analyze those. And if the residual risk is not in an acceptable level, then there needs to be a mitigation output that brings that risk in line. And then when you think about it, so the fourth piece is the tracking and reporting component, whether it's quarterly, monthly, daily, whatever your time frame is. But it's really, how is that tracking and reporting driving useful outputs, right, that provide good trend analysis, forward-looking considerations, friendly to use, and in the end, forming and crafting the ability to make better decisions that control risk. And lastly, the non-negotiable, is your ERM solution manageable? Is it a process that leverages technology but doesn't lose sight of the need for subject matter expertise, and that ultimately it should be efficient? And bear in mind, what has kind of changed a little bit, and I'll talk about this in a second, is when we look at the latest COSO definition of ERM, in the end, even COSO says it is about, manage risk in creating, preserving, and realizing value. So does your ERM system manage risk in creating, preserving, and realizing value? And to me, that kind of sums up a big component of what your platform is all about. So as we go through some quick basics, we talk about COSO, right? So ERM, kind of was defined by COSO back in 2004. And to be honest with you, it was pretty much a process-driven emphasis, right? It was a process of and they kind of defined it as a top-down approach and strategy setting and identifying potential events that may affect the entity and basically take you off track of hitting your business objectives. As you look at where COSO has gone in 2017, it really talks about the inclusion of the organization's culture and capabilities, business practices, and integrating those things in setting your strategy. But in the end, it's all about, the organizations rely on ERM to manage risk in creating, preserving, and realizing value. So if you really think about it, it went from a process-driven focus to a results-driven process. And I think that's kind of critical in understanding the evolution of where ERM is going. A quick word on top-down versus bottom-up. They're both out there. Many of you who already have an ERM system might be using a top-down approach. You might be using a bottoms-up approach. Everything we're going to talk about today is top-down. So if that's not something you're interested in, I could save you a few minutes and you can exit early and you won't hurt my feelings. But we are talking about two different methodologies in supporting ERM. They both do a really good job of doing that. Top down really is more about enabling management to make better decisions based on a magnitude of risk that either supports or impedes the bank's ability to perform. That's what ERM is doing. A bottoms-up system does that, but it tends to take more of a granular perspective around policies, processes, systems, and controls, which are critically important to an operation. Somehow, I believe there needs to be a nexus between the two. A top-down approach definitely gets to what are the high-impact items that support the strategic intent of the bank and where you want to go, and how do I control my risk? How do I optimize performance in the least risk exposed environment? And that's kind of a top-down approach. And so if you can find a middle, but we're going to be talking mostly about top-down today. But I'm not here to be critical of either approach, other than the fact is some ERM system is probably better than none. And then just lastly, and from a process standpoint, if I were to say non-negotiable in another way, your ERM system needs to do 4 things, and you need to be able to say this is what it does, and that is identify risk, measure risk, monitor risk, and control risk. A top-down approach does these things up front. It tends to do a better job of integrating strategy. It tends to set the table more effectively from a risk appetite perspective. But in the end, think of your enterprise risk assessment as a means to identify risk. Think of top risk analysis as an approach to effectively measure your risk. Then monitoring is who gets what and when. And control is making better decisions to control the level of risk exposure that you are dealing with on a day-to-day basis in pursuit of your strategic intent. So from a continuous improvement standpoint, think of ERM as a process that continues to evolve through identifying, measuring, monitoring, and controlling risk. So with that, let's take a deeper dive and talk about what we do in each of these components. When I started out, we talked about forward-looking, and we talked about these 5 non-negotiables. So let's talk about how we leverage those non-negotiables. Real quick definition, right? Risk appetite is the level of risk that your bank is prepared to accept in pursuit of your financial goals and objectives, right? Your performance goals. Your risk appetite does set the direction and the parameters of the level of risk you're willing to take or not take to create that value, right? But here's the important part as we think about 2020 and beyond. Your risk appetite really serves as a blueprint to calibrate your risk assessment system accordingly. So when you take a look, and this is a typical heat map for your risk appetite, and I mentioned up front, if your enterprise risk management system today does not tell you what your risk appetite is by minimally key risk categories, then it's not fully fulfilling its intent, right? But if I know I'm willing to take more risk and credit, maybe because I run really high, I'm a SBA regional lender and I have super high CRE concentrations, or I have a multi-complex digital platform to deliver my loan systems, whatever. If I have higher risk appetite here, I need to make sure there's a connectivity between the risk I'm willing to take and my ERM assessment system in order to help me control that risk. And so your risk appetite isn't just about what you're willing to do and not do to make money. It's about calibrating the entire balance of your system. And so when you think about risk appetite, think about it in terms of outputs, right? So what do I need to do within my ERM system, whether I have one today or I'm adopting one tomorrow? What do I need to do? Well, that heat map is pretty straightforward. And I mentioned earlier, it should minimally consist of key risk categories, which would include credit risk, interest rate risk, liquidity risk, operational risk, compliance risk, strategic risk, reputation risk, cyber risk. But for those of you that might have a payments platform, it would have your payment system. If you have trust, it would be trust, mortgage departments, insurance. We're becoming such a broad, diverse financial service industry. You want to make sure that you have your key risk categories laid out, and then answering the question of, am I willing to, is my risk appetite low to high, right? And that's what the heat map does. I'm going to talk about that in a little bit. Once you have that heat map laid out, the job's not done, right? You have to define what you mean by what level of risk you're willing to take. So if you say your credit risk is moderate, how so? Help me define that. We'll talk about that briefly. And then ultimately, how do I measure if I'm staying within my risk appetite? And that could be done in the form of quantifying Key risk indicators, or if you prefer key performance indicators, they're both there. Key performance is what it sounds like. It's the performance of the bank. Key risk indicators can be external or other comparative analysis factors, right? So these are the primary outputs that are non-negotiable in that risk appetite in today's ERM requirements. Now, when you think about defining your risk appetite, what are some of the questions you need to answer? And growth is one of them. So when you're taking a look at your bank and where you're going and what that growth is going to do. So if you've got a double-digit growth appetite in a single-digit growth environment, you're taking on more risk. Now, some people might say, well, that's inherent risk. Well, it's also risk appetite. If you want more than your fair share, generally speaking, that means you're willing to take more risk. So growth is a primary factor. If you are proactively or even opportunistically looking at mergers and acquisitions as an opportunity to serve your bank, you have an elevated risk appetite. If you are entering into fintech partnerships to either identify customers, more effectively deliver products and services, or move to a digital environment, that lends to your complexity and can influence and elevate your risk appetite. And that could do it operationally, IT-wise. Think about that just from a vendor management standpoint. If you're entering into multiple new relationships with fintech companies, do you have the level of skill set necessary to negotiate those contracts? These are all things that influence your risk appetite, right? The number of channels you have. If you're moving from basically your branch system to maybe your business bankers, to an online system, to a mobile system, to a digital platform, to third-party providers, to broker networks, these are all levels of complexity that define the level of risk you're willing to take, and also meaning defining the level of controls that you have to have in place to control that risk. And then, to throw in some additional factors, think about your asset quality, the level of concentrations, and concentrations can come in the form of product concentrations, customer concentrations, deposit concentrations, loan concentrations. All these factors go into driving, is your risk appetite low to high? And is it a risk that falls into credit? Is it a risk that falls into your operations, your liquidity, your interest rate environment, your overall strategic risk, your reputational risk? If in fact you are in a retail or consumer-oriented business, that has a bearing on your compliance risk appetite as well as your reputational risk. So think about those things that expose you more, and that kind of reflects what your risk appetite is, right? So those are the key factors you want to take into consideration. So, and when you build those risk appetite statements, really simple. First, describe what the level of risk is you're taking. So if you say that your risk is moderate, explain that to me. And then tell me something about your controls, right? And your controls would speak to generally your capabilities, your policies, your procedures, your systems, third-party dependence, things of that nature. So if you think about, if we're just talking about operational risk, this might be how an operational risk appetite statement might read. Our operational risk appetite is moderate to moderate high when considering our desire to adopt technology solutions that enhance our client experience and improve efficiencies. We also are exposed to increased level of risk associated with ACH and wire volume and size and growing dependency on third-party providers. Boom, that describes why my risk appetite is at a certain place. And then it goes on to say, though, however, we maintain a low to moderate exposure risk from fraud and errors. And then it goes on to say, we have sound policies, procedures in place, and things of that nature. So these are the building blocks to a good risk appetite, should be non-negotiable. In the end, I won't spend a lot of time on this. You kind of know what KRIs are. My emphasis on looking at key risk indicators or key performance indicators, they should fall within low to high. And by the way, if you guys want some sort of boilerplate example, I'd be happy to have Robert send you off an example of how to set up a KRI or a KPI dashboard. The important thing about your KPIs and your KRIs, though, is they should relate back to your risk appetite and also set the framework for your risk assessment system. Some are easier to come up with than others. Certainly quantitative is easier than qualitative. My only encouragement to you in this case is less is more. And then lastly, from risk appetite standpoint, use it to calibrate the balance of your risk assessment system. So identify risk categories that represent the greatest risk, define what within those categories represents the greater risk, and then ensure your risk assessment adequately addresses those risk areas. So that's the role of risk appetite. And I'm going to continue to move kind of briskly through this. But so if that's risk appetite, non-negotiable number 2, your enterprise risk assessment framework. Now, to be honest with you, I don't care if it's Excel-based, web-based, whatever you're looking at. The first thing I mentioned on your enterprise risk assessment system is it should represent both qualitative and quantitative data, right? So needless to say, there's survey or assessment data inputs that are assessing your capabilities and your processes and your systems and your controls. That's great. That's what assessments do. But there has to be a calibration to that. And just to give you a better sense of that, if we were looking at a web-based format, if you're looking at your qualitative, you want to be able to drill down, right? You want to be able to look at your risk assessment areas. But more importantly, can we tie back in those KRIs as well so that we're looking at a holistic view of both our qualitative and quantitative risk? And whether you can look at it by credit risk or interest rate risk, liquidity risk, but for every assessment statement that addresses your inherent risk, your adequacy of risk management, composite risk or residual risk, and direction of risk, there should also be some indicators that could give you some comfort that you have quantitative analysis supporting your qualitative findings. So I do like to kind of point that out when you're looking at the non-negotiables of your risk assessment system. Can you do that with Excel spreadsheets, your own systems internally, or integrating an S&L piece and a Sage piece and all these other things in various ERM platforms? The short answer is yes. But the bottom line is you do want to incorporate both qualitative and quantitative data. And I mentioned, when you look at the level of detail that goes in there, if you can leverage technology, great. It's efficient. But it should be able to have you go from the 30,000 foot down to front end and back again, right? And it should be able to quantify your inherent risk, your adequacy of risk management, your composite or residual risk, and direction, and be able to pull that together, right? And then to the extent of capturing information, it should be useful. Again, I'm using screen captures that show technology. Many of you on this call I know already have ERM systems, and you have systems that are doing this. But it's just important. So I'm kind of emphasizing the ability of data access. Now I'm going to throw you the curve, though, and say, you know what? Technology is worthless if you don't have good content. And if you haven't established the data requirements or a data library and be able to sort that by key risk category, that technology falls short. And so one of the things, and if you guys, this is like a simple data call grid. If you want to make a note and you'd like a copy of this, just as a kind of a roadmap, but a non-negotiable in looking at your enterprise risk assessment system is what it is you're assessing. And this can be complex, right? Because if you're buying a system where you've got to come up with all the measurements, that's great. But you do need to look at, if you're looking at an enterprise risk assessment that looks at credit, what needs to go in there? And it's not just about the traditional processes and products. There's more components to that. So just make sure the non-negotiable is that you have a good library of data, whether it's homegrown, whether you buy it off the shelf, whether you outsource to somebody. But all that good technology, if the content isn't in sync, it kind of leaves you flat. I don't know many of you that might have an ERM system and you take it to the board or management and you've gathered all this information and you think it's all great, and they look at it and they kind of give you that so what look. That means the content isn't quite being either aggregated or produced in a manner that can move decisions and control risk. So think about that as a content role. Okay. Now here's the challenge, here's the challenge, guys. Forward-looking data just doesn't spit out well for many systems. But if your ERM system doesn't recognize you have to consider forward-looking information, we're missing the boat on emerging risks, threats, and opportunities. It could come in the form of economic forecasts, but you want to be able to look out, right? At least within your target markets. And maybe it's national, state, or local data, but your ERM system needs this. If you don't have it, have your vendor work with you or find a way to bolt it on. But if you're presenting ERM results without understanding where the world's taking it, and it could also be regulatory insight documents. These are kind of quantitative, right? Psychodemographics, performance trends. But it can also be looking at OCC semi-annual risk perspective and understanding where they're saying risk is going. It could be looking at FRB's insights and FDIC's insights, or any number of professional service firms that provide forecasting data. But somewhere in your discipline, just because your platform doesn't have this type of data in it, doesn't mean you can't figure out a way to bolt it on. This is probably the most challenging component. That's why we started this webinar saying it's about an ERM system has to be forward-looking. And if I had to identify the single most challenging part of a web assessment, or an enterprise risk assessment, it is tying in the emerging risk threats and opportunities part of the role of ERM. And then lastly, just data outputs, right? And we'll talk about more of this under tracking and reporting. But the ability to access useful information is kind of a non-negotiable for a good ERM system. It should be able to look up at the macro roll-up area. So tell me what my compliance risk profile is. Tell me what my credit risk profile is. But if I want to know what it is specifically in BSA or in fair lending or in deposit products or non-retail deposits or by reg, we need to get to that, and we need to roll down and roll up, and we need to find where the points of pain are. So my point is be able to look at a system, and non-negotiable from a risk assessment system is being able to move up and down through the data in a relatively seamless manner, always thinking in mind is how does this output form better decisions and help us better control our risk, right? So that's kind of the risk assessment system. Real quick word on top risk identification. Most of you have this data available to you. If you have an ERM system, it's out there somewhere. You source the data by top risk, but it's really important to consider three factors when you're thinking about your top risk analysis, and they really should come out of your enterprise risk assessment system. If your enterprise risk assessment system is working, it should be able to tell you where some of the more critical risk exposure is. So, and when you think of top risk, think about their potential adverse impact to earnings, or the balance sheet, or your regulatory standing, or compliance in some area. But there should be an exercise that says, these are my top risks, and I factored into where they reside, I factored into what the current status is, and what is the financial impact to my bank. That's the first step of good top risk analysis. From there, it's really just about answering the question of, if this is my top risk, and define it, and where it resides, what's the likelihood of it occurring? If it were to occur, how severe would it be? And where the heck does that inherent risk reside across my enterprise? And how am I currently controlling that risk? And how would I grade my controls? Is my residual risk okay? Where's this all going? If my residual risk is not okay, and by the way, it could be okay, but if it's not, then what do I want to nominate in terms of mitigating actions to further control that risk? Right? So this component is one that I see in some systems, I don't in others. But if you go through an entire enterprise risk assessment and you can't tell me as a manager, an executive at a bank, what my top risks are and why, then the ERM system is not doing its job. And so this is one way you could do that, right? You can identify those top 3, 4, or 5 risks. If it's a bottom-up approach, it might be top 10, 15, 20, or 30 risks. But a top-down approach would tend to be 5-ish. And it should be able to identify it in some manner similar to this. And ultimately, if you've nominated, they find what those mitigating factors are, it should find its way into a risk mitigation document or plan, however you get there, right? That says, here's my top risk. Oh, by the way, there's an accountable party that owns this risk. These are the things that are going to bring this risk into further control, and this is when I'm going to get them done. And so, we talked about risk appetite, non-negotiable, enterprise risk assessment and what it does, non-negotiable, top risk analysis, non-negotiable, right? So now the fourth of the process, and that is, how do we track and report all this stuff? And though I can't give you one total answer to that, start first of all at who gets what and when. Okay, really simple. And I'm going to tell you, a board of director is not going to be interested in certain things that you on the committee of the risk committee might be interested in. You know, boards have a certain view of things. So the first thing you have to ask yourself from an ERM output standpoint is my content, right? What's going to push out? What are my outputs? Who's my audience? And so that's what this step answers that question. Who gets what and when? So if you think about dealing with your board of directors, trying to tell them that you know you have certain outages somewhere, or you know somebody's not doing their job all that well, and there's a little breakdown in how you do one thing or another. I mean, those are all critically important to an operation. Could be critical to compliance. It may not necessarily get a board member's attention. They're going to say, "Isn't that your job?" So when you think about an ERM output, start thinking about what a board might want to know. You know, what does that director want to know? They probably want to know about what the top risks are. You know, what are the kind of things that are keeping you guys up? What are the kind of risks that are preventing our bank stock from going up? You know, what are some emerging risks or threats we should be sensitive to? What are some key trends in our business model that I as a director need to know about? And if I see a movement, a certain trend that may not be favorable, I can ask the right questions of management, right? And then what are we doing about just what's the current outlook, that forward looking? So the board doesn't need a lot. It should be a relatively, but if you can tie back things that tie your risk appetite and risk profile back to current trends and let them know what that looks like, that's key. Management, or at least senior management, a little broader, right? Give them what the board gets, but more analysis, you know, probably by risk category. More detail around the risk mitigation plan and the status of those things. And then some forward assumptions so if you're the CRO and you're spending time in front of the executive team, or say the audit committee is serving is the ERM committee at the board, you know, share your thinking. You know, does your ERM system allow you to say, based on our data, based on what we see, here's some assumptions we have going forward. ERM could do that. And I'll tell you what, you talk about cost benefit analysis, you get in front of management or the board and talk to them about what your system is telling you about where risk is moving and perhaps how we could more optimize one thing or reduce exposure in another. You're not going to have a lot of budget fights over your ERM platform. And then lastly, that data set, who gets what and when, it's the committee, right? And you own it all. And that's usually chaired by, if you have a CRO, if you're large enough to have a chief risk officer, or you have a surrogate chief risk officer, or you have an outsourced third party, that's where all the data resides. But it really answers the question, who gets what and when, and how is it formed to help make better decisions, right? And when you think about decisions, again, I'm not here to promote a web dashboard or an Excel spreadsheet or a PDF or whatever it is, but think about whatever comes out of your ERM system, that it has some element of actionable intelligence, right? What is this telling me? You know, if I'm looking at this little guy right here with classified exceptions, if I said, hey, the economy's tightening up, I want to see exceptions start moving downward, and I see my heat maps telling me my exceptions are going up, I may want to ask some questions about that. But the important thing is the ERM system has to be able to tie in information that the system generates that can be acted upon, that could form decisions, be it tied to my risk profile, be it tied to a certain risk area of the bank, be it tied to a department. But at the 30,000 foot level, if I want to look at all of my risk in compliance, but if I want to drill down of how we're doing in BSA because we're big on MSBs or we're getting ready to launch into cannabis, your outputs need to be actionable, right? And then lastly, just managing the manageability of and striking the right balance of your ERM system is kind of my last non-negotiable. And what this is really about is understanding that defining the role of ERM really has to do with scoping ERM's role in your bank. It's probably the most important question you need to answer. And the scope of ERM in your bank is going to be different. You know, depending on the size of your bank and the complexity of your bank, your business model, your risk profile, your risk appetite, All these things tend to drive the budget decision on why ERM for you. I think every bank should have an ERM system. Now, what that ERM system does, I'd like it to be scalable, but it does really need to be built around your bank's business model. And it should be output driven. From there, think about the three primary elements. If you're leveraging technology, technology can make the process more efficient. It can make it more accurate. It can make it more dynamic and robust. It could also be a death march if the content isn't the right content or if it's not being reported in the right way. So just remember, if it doesn't adequately produce decision-making outputs, or if you find it's labor-intensive and you become a victim of the platform, that has to be reversed, right? Your technology needs to be focusing on creating, preserving, and realizing value. Subject matter expertise is kind of a non-negotiable, either on staff, through subscription, or through outsourcing. But a non-negotiable and the manageability of it is having good subject matter expertise to make sure your content's right and that you're balancing the use of content to form outputs that craft better risk control decisions. And that also kind of gets into that forward-looking piece. And then lastly, efficiency. Somewhere in there, the way you can get your system most efficient beyond technology, it's getting buy-in. And if your ERM system connects with your risk owners at the senior level, at the mid-level, they become a resource. So when I talk about efficiency, it's not just investing in the right technology, it's investing in getting buy-in across the enterprise. And with that buy-in becomes more resources to make a more effective system. So those are just my thoughts on manageability. So if you really sum it up, and when we started our discussion today, we started talking about things are just getting more intense out there. And ERM does need to be forward-looking. I think it does need to be output and decision-making focused. And there are key processes that are non-negotiable. So as you look at what your ERM system is doing today going forward, ask yourself, and just use this one grid, is, does your risk appetite really establish what you're willing to do and not do to make money? Does it calibrate your risk assessment system? Does it tell you where your risk resides so that your risk assessment process can be more effective? That it can aggregate both qualitative and quantitative data in a way that shows us forward-looking trends, be they risk or opportunities, that they tie in qualitative and quantitative data, and that they could form better decisions? Does your system move into being able to identify what your top risks are so that you could more effectively control it? Do you have tracking and reporting that supports the stakeholders of the individuals that control risk at every level? And is your process manageable? If you are a slave to your system and your system is not a slave to you, those are things worth changing. So kind of my closing thoughts in this brief and rapid fire presentation is ERM goes way beyond regulatory compliance. So when you're looking at GRC, government regulatory compliance, and ERM, don't get them confused. Compliance is huge. It's a big job. But ERM goes beyond that. It goes, COSO's definition is about creating, preserving, and realizing value. 2020 and beyond require a system that really synchronizes your risk management and your performance priorities. Forward-looking intelligence is that key value add that is going to provide either early warnings or illuminate opportunities. In 2020, ERM processes really must manage risk in a way that you can communicate both to your internal stakeholders as well as your board that it's a contributing factor to creating, preserving, and realizing value. So that's kind of our view of ERM 2020. This is kind of our first look at looking at that. I hope you found that value. Before we go to Q&A, just a quick word about us. This is what we do, and what we do is we take ERM, and because we see the relationship of enterprise risk management and strategy and capital, those are the only three things we do. And we pride ourselves on being able to seamlessly integrate these things to serve a bank's optimal performance. And it comes in the form of a full implementation suite. We have module solutions. We have reporting and tracking solutions, as well as audit and enterprise risk integration solutions. So with that, I'd just like to see if anyone has any question regarding any of these components, and I'd be happy to respond to that. Okay, I know I covered a lot of ground. I hope it made sense to you. I do think my closing thoughts, on top of my closing thoughts, are, the industry's never been more competitive. It's never been more difficult to continue to grow, especially as a community bank, which is where we spend most of our time. And I truly believe that enterprise risk management is at the central brain trust, if you will, for banks that are seeking optimal performance, and the right focus on those right non-negotiables creates an indispensable contributing factor to your bank's long-term sustainability. So with that, I will conclude my thoughts. Thank you all for taking time out of your busy schedule. I hope you found this useful. If you would like a copy of our presentation or a recording of this presentation, please let Robert know. Here is his contact information, and we'd be happy to get anything off to you need, as well as if you'd like to spend any additional time with us to drill down even deeper on any of these areas of developing a forward-looking ERM system. Thank you for your time and taking time out of your busy schedule. And good day.